I believe that there's going to be a shortage of 1,000-ounce bars, sometime between $35 silver and $50 silver. The reason why is because these fabricators are going to be ordering these bars because they're out. The retail crowd is basically...
Imagine a world where Silver News Daily, often considered the poor man's gold, skyrockets to an astonishing $3,000 per ounce. It sounds unbelievable, right? Well, according to renowned market analyst Don Durrett, this is not just a wild prediction, but a very real possibility. As geopolitical tensions rise and industrial demand soars, a looming silver shortage could trigger an unprecedented price explosion. Stay tuned as we dive deep into the factors that could lead to this incredible surge and discover why now might be the perfect time to invest in silver. Don't miss out on this potential once-in-a-lifetime opportunity.
You know, Venezuela did it, and look at, it's a total mess, right? Bolivia tried to do it, and they backed off. I mean, it just doesn't work. You know, a lot of people think that maybe Mali right now might nationalize. It just doesn't make sense for countries to nationalize mines because you're going to reduce investment. People are like, well, I'm not going to invest in that country. You know, you're a company. I'm not going to go and do exploration there. So it's a net loss for the companies. However, the risk is once silver gets to $50, there's two things that are going to happen. Number one, they're going to raise their taxes and royalties on silver mines and probably gold mines too. So precious metals, gold and silver, they'll raise their royalties and taxes. But hopefully they won't do it in a severe way that will restrict, because we saw this in Ecuador. When they go too high, when they raise taxes too high, everybody leaves. So they can only raise taxes and royalties so much. Like, you know, Mexico, they're probably only going to raise taxes probably 10%. But just enough do they get a big chunk of the money, but not enough to kind of stop investors. So I only see, you know, the royalties going up, you know, 5-10%. I don't see, like, you know, when Ecuador, they basically bumped it up like 50%. I mean, you can't do that. And I think countries have learned that lesson. The big risk, I think, is countries demanding ownership, small ownership. They call it free carried. Liberia is a good example. In that country, they get 10% free carried. So free carried means they don't have to pay a penny and they get 10% of the revenue. So that's what we're going to see. We're going to see a lot of countries that will go and say, look, and some of them they'll grandfather in. They'll basically say, existing mines, we're not going to go and make you sell 10% of your company. But kind of all new companies, all new mines, it's like that mine, we get 10%. We're going to see a lot of that. And so we don't know how much that's going to impact the mining sector per se. But I think as far as gold miners go, I'm bullish on gold miners. I don't think there's going to be a problem with gold miners, because you're not going to get any shortages in gold. And I don't think that these countries are going to tax people into the ground, take the free carry to an extreme. They're just going to take their pound of flesh, but the miners are going to keep making money. So I'm very bullish to gold miners. I'm not going to sell it. For instance, I don't have any problems waiting to sell my gold miners. A lot of them, I'm going to wait until gold gets to 3,500 before I sell even a single share. I will sell some from 27 to 3,000 for stocks that are up a lot. You know, the stocks that are up a lot, I'll start taking profits around 2,700. But not a lot. I'll take a lot more profits at 3,000. But a lot of these companies, I won't even touch them until we get to 3,500 with gold, because I'm not worried about nationalization, taxes, and that stuff. Because again, I don't think they're going to impact or just injure the sector.
Currently, silver is trading at around $30.80 per ounce, showing a significant upward trend despite strong U.S. economic data and hawkish remarks from the Federal Reserve. Recently, prices even peaked at $30.92, driven primarily by escalating geopolitical tensions, particularly in the Middle East. Israeli airstrikes in Gaza and retaliatory actions by Hamas have created a risk-off sentiment in the market, pushing investors towards safe haven assets like silver. However, the rise in silver prices hasn't been smooth. Strong U.S. economic indicators, such as the unexpected increase in durable goods orders and higher consumer sentiment, have bolstered the U.S. dollar. A stronger dollar typically makes silver less attractive as it becomes more expensive for investors holding other currencies. Additionally, the Federal Reserve's stance on maintaining higher interest rates to curb inflation has further limited silver's gains. Despite these headwinds, the underlying demand for silver remains robust. The metal's role as a hedge against market uncertainty and inflation continues to attract investors. Moreover, the market anticipates further volatility due to ongoing geopolitical crises and upcoming U.S. economic data releases. This delicate balance between geopolitical risks and economic indicators sets the stage for potential dramatic movements in silver prices, keeping investors on high alert.
The G7 could basically recognize that we have inventory problems on silver, and they could call silver a strategic metal. And I think that's what's going to happen, but I don't know when. But my guess is somewhere between around $75 silver, somewhere in there. I don't think it'll happen 50, because it's going to take some time for all that stuff to unfold. But I think somewhere around 75, so our silver miners start adding a lot of risk, because we could see, if they do call that a strategic metal, we could see silver drop like $20 in a single day. And if that happened, your miners could drop, all of them, all your silver miners could drop 25% or more in a single day. That could happen if they made that type of announcement. And the other thing that would be ugly is if it was just a rumor. So if there's a rumor that they were going to call it a strategic metal, then that would put headwinds on our stocks, and they would stop going up, and they might, that would be kind of ugly, right? It's like, because at $70 silver, a lot of these stocks are going to have really big multiples. We're going to see stocks that have multiples in the 20s that normally you would think they'd be, 10 to 15. And so they're going to be they're going to be perceived to be overvalued. And so then if they're perceived to be overvalued, then the rumors come in, they're going to make it a strategic metal, then they could get sold off just on the multiple basis alone. And so that's a big risk we have to consider. I mean, you could be, especially people that are getting in late, and then, their profits could disappear overnight. But so I'm going to sell to the top for this, because I see this risk. I see this possibility of silver basically if you have shortages, I think they will call it a strategic metal. Just think of all the big companies that need silver, right? GM, Toyota, Volkswagen, Apple. I mean, these are big companies, right? And then any company that makes computers, NVIDIA. These companies go and they go, look, we can't find any silver. Do you really think that the government's not going to listen to these guys? Of course they are. So if there's any shortages at all, I got to believe they'll call it a strategic metal. And I think that's coming. Now, a lot of people say, Don, if they do that, they can't still stop the price from silver going higher. And, maybe they have a good argument there at a certain point. Yeah, silver drops initially, but that inventory problem is kind of still there. And can they really resolve it by basically ending? I haven't even talked to, the ramifications that they call it a strategic metal. So the first thing the ramifications is they would basically outlaw ETFs. So the ETFs have about $1 billion of silver ounces. So that would immediately go on the market. So you dump 1 billion ounces that's a lot of excess silver. I mean, right now the demand is about 1.2 billion. So if you dumped 1 billion, that would get you, probably 3 years of inventory. And so I think it could really put a big kibosh on the silver miners at a certain point. But over time, silver they would use up. Once that's done, once they work through that inventory, then the price would start going back up again. It's something to think about, if you will. And I do think about it. So, I like I said, right around.
Let's delve into how economic data and monetary policy are shaping the landscape for silver prices. Recently, we've seen robust U.S. economic data that has significantly impacted investor expectations. For instance, U.S. durable goods orders rose by 0.7% in April, defying expectations of a 0.8% decline. Additionally, the University of Michigan's Consumer Sentiment Index climbed to 69.1 in May, surpassing forecasts. These positive economic indicators have contributed to a stronger US dollar, which generally puts downward pressure on silver prices. Moreover, the Federal Reserve's hawkish stance has played a crucial role in shaping market sentiment, with the Fed signaling a commitment to maintaining higher interest rates to combat inflation. The likelihood of immediate rate cuts has diminished. This expectation of sustained high interest rates has reinforced the dollar's strength, further challenging silver's appeal as an alternative asset. However, the market is also acutely aware of potential shifts in monetary policy. Any signs of economic slowdown or changes in inflation dynamics could prompt the Fed to reconsider its approach. This uncertainty keeps investors on edge, as unexpected changes in interest rates could quickly alter the attractiveness of silver. For instance, if the Fed were to signal a dovish pivot due to economic pressures, it could weaken the dollar and reignite a rally in silver prices. Additionally, upcoming U.S. economic reports, such as first-quarter GDP data and key Federal Reserve speeches, are critical to watch. Positive GDP data could bolster the dollar further, while any dovish hints from the Fed could provide a boost to silver. Thus, the interplay between economic data and monetary policy remains a significant driver of silver's market performance, adding a layer of complexity to price predictions.
Expecting a shortage. So 5 and 10 ounce bars are made from 1,000-ounce bars. 1,000-ounce bars, that's what all the fabricator buys. When you look at a pallet of silver, those are 1,000-ounce bars. They're not exactly 1,000-ounce bars because it's too difficult to make exact 1,000-ounce. So they're plus or minus about 3 ounces, maybe 10 ounces of 1,000. And those big, huge things, they weigh 75 pounds. They're heavy, really heavy. So those are what they make the 5-ounce and 10-ounce bars from. I believe that there's going to be a shortage of 1,000-ounce bars, sometime between $35 silver and $50 silver, depending on how fast silver goes up. But somewhere around there, I think the reason why is because these fabricators are going to be ordering these bars because they're out. And they're like, I got to the retail crowd is basically going to overwhelm the inventory levels. So about 70% of your silver is used by fabricators and 30% by investors. And last year, it was actually higher than 30% for investors. And I think it might be higher this year. So last year we had I think it was over 200 million ounce deficit. It was 170 million to 200 million ounce deficit. So that had to come out of above ground inventory. Well, this year the deficit is higher. This year it's above 200. And so where's that coming from? And so those are all 1,000-ounce bars. Once you're out, once the inventory is out, now, one of the things we're seeing finally in this question here is we're seeing the inventories drop at the ETF level. Well, you can actually take delivery at SLV if you're a participant, but you have to take 32,000 ounces. You can't take, people like us can't do it. It's basically a ton. You can take 1 ton. You can sell a ton and take delivery. And we're seeing the inventory levels drop while silver goes up. And I think that they're using the ETFs as inventory.
To truly grasp the potential for silver prices to reach $3,000, we need to look back at the metal's volatile history and its moments of dramatic price spikes. Silver has always had a reputation for being unpredictable, often disappointing investors with its erratic behavior. However, there have been several notable moonshots in its price that hint at its explosive potential. In the late 1970s, silver experienced one of its most famous surges. Driven by the Hunt brothers' attempt to corner the market, silver soared from below $5 per ounce in 1978 to nearly $50 per ounce in 1980. This meteoric rise was short-lived, and prices plummeted just as quickly, illustrating the metal's extreme volatility. Fast forward to 2008 to 2011, and we see another significant spike. In the aftermath of the global financial crisis, silver prices climbed from below $8 per ounce in 2008 to almost $50 per ounce in 2011. This surge was fueled by economic uncertainty and increased demand for safe haven assets. However, just like in the 1980s, the rally was brief, and prices eventually fell back down. These historical peaks, although fleeting, reveal silver's capacity for rapid price escalation under the right conditions. The factors that drove these past moonshots, market manipulation, economic turmoil, and heightened investor demand, are relevant today. The current economic environment, with its mix of geopolitical tensions, inflationary pressures, and industrial demand, creates a backdrop where another dramatic rise in silver prices is conceivable. Furthermore, the historical silver-to-gold ratio provides additional context. Traditionally, this ratio hovered around 15:1, reflecting the natural abundance of silver relative to gold. However, in recent years, the ratio has skewed dramatically, sometimes exceeding 80:1. This discrepancy suggests that silver is significantly undervalued compared to gold, reinforcing the potential for a substantial correction. As we look to the future, understanding these historical patterns helps us appreciate why experts like Don Durrett believe another silver moonshot is not just possible, but increasingly likely. The combination of historical precedent and current market dynamics sets the stage for potentially explosive growth in silver prices.
A perfect reason why I think I'm right. I actually predicted this back when I wrote my book in 2010, that it's inevitable that basically we'll run out of 1,000-ounce bars because so much of silver is used for fabrication, 70% plus. Silver's used, you can't make anything electronic without silver. You can't make a vehicle without silver. And solar panels use a ton of it. And then the windmills use a ton of it, and electric cars. So it's just, silver's needed, if you will. It's needed for all these fabricators. So then it's the investors that go in and basically cause the problem. The investors, again, when it's a proxy, the investors basically, suddenly they want it, and they call it the silver squeeze. But here's the point I was going to make about how I kind of can show you how it's happening. In 2021, the Shanghai Exchange had 3,000 tons of silver. In April, over 100 tons left the exchange. Today, so it's in April 1st, it was over 900. It started. So it went from 3,000 tons in 2021. And then April 1st, it was over 900 tons. And now we're in May. It's now below 800. So they have less than 800 tons, and it's been dropping over 3 years, and it's dropping at a faster pace. So if they drop 50 tons a month, they're going to have a problem in 6 months. So they already have one. And so where are they going to get the silver to replace? Where are they going to go and find 500 tons? Are they going to still, are they going to rob Peter to pay Paul kind of thing? Are they going to go steal it from another exchange, or, because there's no inventory, because they can't get it from producers. Good luck with that. All that silver is already taken. There's a voice for it already. So they got to go. How are these places going to resupply themselves? So COMEX has actually done really well. I found it really interesting. If you look at the inventory at COMEX, it really hasn't shrunk very much. But I think that's going to happen soon, if you will. Once these shortages, once silver gets above 35, I think you're going to see the COMEX start losing 50 tons, 100 tons a month as well, just like Shanghai. The other thing I'll leave on this inventory thing is there's only 3 places where you can basically find inventory: the Shanghai and COMEX, and then the LBMA in London. Those are really the only 3, other than the ETFs. But the ETFs, again, those can only be you can only take delivery if you're a participant, and you have to take 1 ton at a time.
Silver is not just a precious metal. It's a vital industrial commodity with a myriad of applications in modern technology. This dual role significantly impacts its market dynamics and underpins its potential for price increases. Understanding silver's industrial demand is crucial to grasping why a shortage could drive prices to unprecedented levels. Silver's unique properties, including its high electrical conductivity, thermal conductivity, and reflectivity, make it indispensable in various industries. For instance, every smartphone, computer, and numerous other electronic devices contain silver. It's used in the manufacturing of batteries, solar panels, and even in medical applications due to its antimicrobial properties. One of the most significant drivers of silver's industrial demand is the green energy sector. Silver is a critical component in photovoltaic cells used in solar panels. As the world increasingly shifts towards renewable energy sources, the demand for solar panels, and consequently for silver, continues to rise. According to the World Silver Survey, Nearly half of all silver demand comes from industrial applications, with solar energy being a major contributor. Furthermore, the automotive industry is another key consumer of silver. The rise of electric vehicles, EVs, has boosted silver demand, as these vehicles require more silver for their advanced electronic systems compared to traditional gasoline-powered cars. As the global push for electric vehicles intensifies, this trend is expected to continue, further straining silver supplies. In addition to these high-tech uses, silver is also crucial in more traditional applications such as jewelry, silverware, and coins. While these uses are less significant in terms of volume, they still contribute to the overall demand for the metal. The growing industrial demand for silver highlights its essential role in the modern economy. As these industries expand and technological advancements continue, the pressure on silver supplies will only increase. This situation is exacerbated by declining silver production and dwindling stockpiles on major exchanges. Given silver's critical importance in various high-growth sectors, any disruption in supply could have severe consequences. The combination of increasing industrial demand and potential supply constraints sets the stage for a significant price surge. This context is key to understanding why experts like Don Durrett foresee silver prices skyrocketing to $3,000 and beyond, as the metal's industrial demand continues to outpace supply.
It wasn't a majority rule. It was 100% across the board. So India basically vetoed any discussion. If you remember, they barely talked about it. Do you remember? They barely talked about the BRICS currency. And why? Because it wasn't a majority rule. It was a majority rule. They're like, yeah, we're talking about it. We don't care what you have to say. But the BRICS originally were countries, 5 equal countries. It was never a democracy. It was always equal partner, and each partner has to agree kind of thing. So now they're trying to expand this thing to like 25 countries. And I think it's going to go to 50 plus. So at a certain point, it's probably going to be a majority rule kind of thing. But when it was 5 countries, India had a veto. Now, does India still have their veto? We're going to find out in October. If they still have their veto, then they won't even talk very much about it, the BRICS currency. But if India is basically backed into a corner where they have to take it, then they'll talk about it. So it's going to be really interesting. Now, the one thing we haven't discussed is how does that impact gold? If they create a BRICS currency, I guarantee you it benefits gold because gold is going to be part of that currency. Absolutely. Because gold is something that China and Russia have been accumulating, and they want that currency to be backed by gold. They want to be backed by gold for several reasons. But the number one reason is stability of the currency. They saw what happened to the U.S. dollar. The U.S. dollar got deflated into the ground. They don't want this BRICS currency to get deflated into the ground either. So they want gold to basically be the substantial holding. I wouldn't be surprised if gold is at least 25% of it, maybe even 50. The 25 to 50 is my expectation, and then the rest is either going to be currencies or currencies and commodities. I think it's just going to be gold and currencies. That would make sense. The one thing that I'm shocked that they're not doing, because, and I think people are going to find this fascinating, what I'm about to say, is if you go back and you look at what Facebook was trying to accomplish with their cryptocurrency, now I can't think of the name. Maybe I'll remember it when I'm thinking through this. So Zuckerberg, he basically said, I'm going to create my own cryptocurrency, and it's going to be based on all of the currencies around the world. So they balance each other out. So basically, it becomes the value of all the currencies around the world. It was Libra. It was called Libra. And so the Libra coin is absolutely a brilliant idea, because what you can do with the Libra, let's say you use 25 currencies, right? And then you rebalance those currencies on a daily basis, the ones that go up and the ones that go down. So it's basically a stable coin backed by currencies. So it's not backed by gold, but it's backed by currency.
Geopolitical tensions are a major catalyst for silver price fluctuations, often driving investors towards safe haven assets. Recent events in the Middle East provide a stark example of how global uncertainties can influence the silver market. Escalating conflicts, such as the Israeli airstrikes in Gaza and the subsequent rocket attacks by Hamas, have created a climate of fear and uncertainty, prompting investors to seek refuge in assets like silver. Historically, periods of geopolitical instability have led to spikes in silver prices. For instance, during the 1979 Iranian Revolution and the subsequent oil crisis, silver, along with gold, saw significant price increases as investors sought protection against economic and political turmoil. Similarly, the Gulf War in the early 1990s and the 9/11 attacks in 2001 triggered safe haven buying, boosting silver prices. In the current context, the tensions between Israel and Hamas are just one example of the geopolitical risks that could impact silver prices. Other potential flashpoints include the ongoing conflict in Ukraine, rising tensions between the United States and China, and instability in various other regions around the world. These situations create a backdrop of uncertainty that can drive investors towards silver. Furthermore, geopolitical events often lead to disruptions in the global supply chain, affecting the availability of silver. For example, sanctions or conflicts can limit the export of silver from key producing countries, tightening global supply and driving prices higher. This was evident during the Russia-Ukraine conflict, where sanctions on Russian commodities impacted global markets. In addition to immediate crises, longer-term geopolitical trends also play a role. The trend towards deglobalization and the reshuffling of global alliances are reshaping trade patterns and economic policies. Countries are increasingly prioritizing economic security and self-sufficiency, which can impact the supply and demand dynamics of critical commodities like silver. Geopolitical influences also intersect with economic policies, as governments respond to crises with monetary and fiscal measures. For example, increased government spending on defense and infrastructure during times of conflict can stimulate demand for industrial metals, including silver. At the same time, central banks may adopt more accommodative monetary policies to support their economies, weakening their currencies and making precious metals more attractive. The interplay between geopolitical tensions and silver prices underscores the metal's role as a safe haven asset. Investors seeking to protect their wealth from the unpredictability of global events often turn to silver, driving up demand and prices. As current geopolitical risks persist and new ones emerge, silver's appeal as a refuge from uncertainty remains strong, supporting the potential for significant price increases.
Finally stopped going up and we started going down. So we're down about 6%. So I actually wrote this down. So silver in New York got to 32.40 on May 20th. So 4 days ago. It got to its high of 32.40, and now it's down to 30.30. So it's down about 6.5%. And gold got to 24.50 on the same day, May 20th, and now it's down to 23.32. Now, these are about 5 to 6% corrections, which it's not very severe, if you will. These are really minor corrections. I think gold is going to correct a lot more than this. This run up to gold at 24.50, I really don't think that's going to hold. Now, it looks like I've been saying, I haven't been really excited about this move. A lot of people are super excited, right? Super bullish, thinking this is it. Now, I do agree that gold, silver, and the miners are basically breaking out of this 3.5-year correction that started in August of 2020. I definitely agree that correction is over. However, we are not in that period yet of kind of blue skies off and running kind of thing. A lot of guys are saying everything's great, we're off and running, but there's still a very, very important factor that's not in play yet. And that factor is the stock market's too strong. In order for gold to have this generational run, this kind of big run that we all kind of want, the only way that that's going to happen. In other words, I chase alpha, I chase free cash flow, so I want big moves. I want to see $3,000 gold, $3,500 gold. Well, you're not going to get there until basically gold outperforms the stock market, and the stock market is underperforming. Last time we had that was from 2001 to 2011. And that's when gold was significantly outperforming gold. So gold went from $250 to $1935. Massive move by gold, right? So it was outperforming the stock market. And the stock market from 2000, 2001, and 2011 had a lot of headwinds because we had a lot of problems in that decade. And so the problems haven't manifested this decade yet. But we've had a lot of problems, and there's a lot of underlying, and this is where it gets real interesting. It hasn't manifested yet, and I think it will. This is where it gets really, really interesting. It's like, what's going to be the trigger that manifests that risk off trade? That's what I want to see.
Investor sentiment plays a critical role in driving silver prices, especially when market conditions align with the metal's perceived value as both a safe haven asset and a strategic commodity. Currently, sentiment towards silver is particularly bullish, spurred by a combination of economic uncertainties, geopolitical tensions, and a robust industrial demand narrative. Recent market behavior indicates growing interest among investors in silver. For example, in times of economic uncertainty or stock market volatility, investors often turn to precious metals like silver as a hedge against risk. The COVID-19 pandemic provided a clear illustration of this, as silver prices surged alongside gold when the pandemic first hit, driven by fears of economic downturn and inflation. Prominent market analysts, like Don Durrett, amplify this sentiment with their bold predictions. Durrett'S forecast of silver prices reaching $3,000 has captured the attention of both retail and institutional investors, encouraging more people to consider silver as a lucrative investment opportunity. His insights, based on extensive market analysis and historical patterns, suggest that silver's current undervaluation could lead to significant price corrections in the future. The influence of retail investors cannot be underestimated. Platforms like Reddit and YouTube have seen a surge in discussions about silver, with communities of retail investors rallying behind the metal. This phenomenon, similar to the GameStop and AMC stock surges, highlights the power of collective sentiment in driving market movements. Retail investors, inspired by the potential for high returns, are increasingly buying into silver, further tightening supply and pushing prices up. Institutional investors are also showing renewed interest in silver. Hedge funds and large investment firms recognize silver's dual role as an industrial metal and a hedge against inflation. They are adjusting their portfolios to include more silver, anticipating that the metal's price will rise as economic conditions evolve. This institutional buying adds significant upward pressure on silver prices. Moreover, exchange-traded funds, ETFs, focused on silver have seen increased inflows. These financial instruments allow investors to gain exposure to silver without physically holding the metal, making it easier for a broader audience to invest. The popularity of silver ETFs reflects strong investor confidence in the metal's future performance. Investor sentiment is also shaped by broader economic narratives. For instance, fears of inflation and currency devaluation drive interest in tangible assets like silver. With central banks around the world adopting loose monetary policies and engaging in massive stimulus programs, concerns about fiat currency stability are growing. Silver, like gold, is seen as a hedge against these risks, attracting more investors to the market. Finally, the sentiment is bolstered by silver's historical performance during economic crises. Investors look at past events, such as the post-2008 financial crisis rally, and see potential for similar gains in the current environment. This historical context, combined with present-day economic and geopolitical factors, creates a compelling case for silver.
In 1980. A lot of people think it's going there again, and it could. My target is 30, which I think is a good number. I think we are going to go somewhere between 30 and 40. And so that's 2x. We're currently, I think we were at 90 really recently. It squeezed from 90 to 75 really fast. That's what the proxy thing does, is the silver moves from a commodity type of an investment to a hedge type of an investment. So it's it becomes somewhat of a monetary metal. When it does that, it's mined at 10 to 1. So if it's mined at 10 to 1, how can you sell it at 90 to 1? So if it's mined at 10 to 1, once it becomes a quasi-monetary metal or a hedge, you're going to get that GSR squeezing. So you get this 2x leverage. And it actually could be better than 2x. I actually think it's about 2.5, because if you go from 90 to 30, that's more than 2, right? So it's about 2.5. That's huge leverage, and you get all that leverage in the silver miners. And I was telling people back in October and November to buy these Mormons. I had these 7 silver miners. I said, buy those to the bottom, and because you have this huge leverage. I mean, even today, they all print as 5-baggers at $100 silver. Even after this, they've made a bit of a run, but they're still cheap. But we're getting closer and closer. So once you get to 35, you have more and more people running into miners. You have more and more people buying physical silver. I actually think that once you get to 35, it's going to be hard to find 5-ounce and 10-ounce bars, silver bars, because that's what people can afford. A lot of people buy 100-ounce bars. So those might linger a little bit, but 5s and 10s, those things will disappear so quickly. It'll make your head spin. And these websites will be out really fast. All of your coin dealers will be out. They call it unobtainium, and that's what will happen. And so the last one is going to be APMEX, which has the largest inventory. Once they're out of 5 and 10-ounce bars, it's going to be really fascinating. And that's the point where silver, because of the lack of physical. Usually, a paper market kind of controls the price, but once those 5 and 10-ounce bars are gone, I think that the physical will get some upward pressure.
One of the most compelling reasons for the potential surge in silver prices to $3,000 is the significant constraints on its supply. Silver production has been facing numerous challenges that limit its availability in the market, exacerbating the potential for a dramatic price increase. Firstly, silver mining is a complex and capital-intensive process. Many of the world's primary silver mines are reaching maturity, leading to a decline in output. New silver mining projects are scarce, partly due to the high cost and regulatory hurdles associated with developing new mines. Environmental regulations, geopolitical risks in mining regions, and the lengthy approval processes further complicate the expansion of silver production. In recent years, major silver-producing countries like Mexico, Peru, and China have reported declining silver outputs. For example, Peru, one of the largest silver producers, has faced political instability and stricter environmental regulations that have hampered mining activities. Similarly, in Mexico, which leads global silver production, cartel violence and operational challenges have impacted output levels. Additionally, silver is often a byproduct of mining for other metals like gold, copper, and lead. The production rates of these primary metals directly influence the availability of silver. When prices of these primary metals decline, the production of silver as a byproduct also decreases, further tightening the supply. The COVID-19 pandemic exacerbated these supply constraints. Lockdowns and restrictions disrupted mining operations worldwide, leading to a significant drop in silver production. Although some recovery has been seen as operations resume, the overall impact has left a lasting dent in silver supply chains. Furthermore, stockpiles of silver on major exchanges have been depleting. For instance, the London Bullion Market Association, LBMA, reported some of the lowest stockpile levels on record. Similarly, inventories in New York and Shanghai exchanges are at seasonal lows. These dwindling reserves indicate that the market is already experiencing tight supply conditions, which could become more pronounced if demand continues to rise. Recycling, another source of silver, is not sufficient to meet the growing demand. While silver recycling does contribute to the overall supply, the process is limited by economic and logistical factors. The amount of silver recovered from recycling is relatively small compared to the overall market demand, and recycling rates fluctuate based on silver prices and technological advancements. Another significant factor is the shift towards renewable energy and electric vehicles, both of which heavily rely on silver. The green energy revolution is increasing the demand for silver in applications like solar panels and electric vehicle batteries. As these industries expand, the strain on silver supply will intensify, further driving up prices. The combination of declining mine production, reduced byproduct output, depleting stockpiles, and increasing industrial demand creates a perfect storm for silver supply constraints. These factors underscore the metal's scarcity and highlight the potential for significant price increases as demand outstrips supply. Understanding these supply dynamics is crucial for investors. As the availability of silver becomes more restricted, the pressure on prices will mount. This supply-demand imbalance sets the stage for a possible price surge, making Don Durrett's prediction of $3,000 silver not just a speculative fantasy, but a potential reality driven by tangible market forces.
Think that gold was going to lead here because the stock market has been so strong for, it's going on now, 16, 18 months, quite a run. I thought that, the economy is usually something that slows down gold. They usually don't go together. It's usually if the economy is strong, then gold has trouble. I consider the economy kind of the kryptonite for gold. And so this is a really, this is where people are really confused on what's happening today. So gold broke out March, and then silver followed. It was pretty amazing. It went from like 25 to 32, $7 fairly quickly. And then in China and Shanghai, it went all the way to 36. So China was leading, and China was leading gold as well. It was Shanghai is where they do the futures trading in China. And so you had these really big opens on Sunday night in China starting in like right around March 20th with gold. And then, there's really nothing New York could do but kind of follow that lead by China. And then the same thing happened with silver. China was like well over $30. And it stayed there. And, New York couldn't have that huge premium. We actually had the premium up to 17% yesterday, and now it's down to, I think, 12 or 13. So China is still selling silver at $34, over 34. It closed in Friday on China. And so 34 something, 34, 30, 34, 50 versus $30 in the US. So it's about 15%. So we have these big premiums. We have the combination of central bank buying. So the central banks have been buying about 80 tons a month for the last 2 years. It's been pretty staggering, the consistency of the central banks buying gold, about 1,000 tons the last 2 years, and it's been picking up. And so it's a combination of the central banks and China buying gold, and New York doesn't really want to buy gold. They don't want to buy miners, but they've had to. So it's created a kind of a conundrum here on, kind of what's happening. Now, this is leading up to kind of answering your question, what's going on with silver right now. And so this week, we had this big run-up, which...
The silver mining industry plays a pivotal role in the metal supply chain, and its current state adds significant weight to the argument for a future price surge. Understanding the dynamics within this sector helps explain why silver could realistically reach $3,000 per ounce. The silver mining industry is marked by several key characteristics and challenges. Firstly, silver mines are often located in politically unstable regions, which introduces a high level of risk. Countries like Mexico and Peru, which are major silver producers, frequently face political turmoil, regulatory changes, and social unrest that can disrupt mining operations. For instance, strikes, protests, and government interventions can halt production, creating supply shortages in the global market. Moreover, silver mining companies are grappling with rising production costs. Extracting silver from the earth requires significant investment in equipment, labor, and energy. As ore grades decline, meaning the concentration of silver within the ore is lower, mining companies must process more material to produce the same amount of silver, further driving up costs. Additionally, energy prices and labor costs have been increasing, squeezing profit margins for mining companies and making it less economically viable to ramp up production. Exploration and development of new silver mines also face substantial hurdles. The process of discovering new deposits, proving their economic viability, and bringing a mine into production can take over a decade. This lengthy timeline, combined with environmental regulations and community opposition, means that new silver mines are slow to come online. As a result, the industry struggles to replace depleting reserves and meet growing demand. Investment in the silver mining sector is another critical factor. While there has been some renewed interest in mining stocks, the sector has historically been underfunded. Many investors view silver as a volatile commodity, leading to cautious investment strategies. Without sufficient capital, mining companies find it challenging to invest in new technologies, expand operations, or explore new deposits. This underinvestment limits the industry's ability to boost production in response to rising demand. Despite these challenges, there are opportunities within the silver mining sector that could contribute to the metal's price surge. Junior mining companies, which focus on exploring and developing new deposits, hold significant potential. These smaller firms often operate in unexplored or underexplored regions, and a successful discovery can lead to substantial returns. As silver prices rise, investment in these junior miners could increase, leading to new sources of silver supply. However, these developments take time, and the immediate impact on supply is limited. Furthermore, the silver mining industry stands to benefit from technological advancements. Innovations in mining techniques, such as automation and improved ore processing methods, can enhance efficiency and reduce costs. While these advancements can boost production, they require significant investment and time to implement on a large scale. The interplay between supply constraints and industry challenges creates a precarious balance. As silver demand continues to rise, driven by industrial uses and investor interest, the mining industry's ability to respond is limited. This imbalance between supply and demand supports the argument for a dramatic price increase. Investors should pay close attention to developments within the silver mining industry. Companies that manage to navigate these challenges effectively and increase production will be well positioned to capitalize on higher silver prices. Additionally, strategic investments in junior miners and technological advancements could provide significant returns as the market evolves. In conclusion, the silver mining industry's current state underscores the potential for a significant price surge. The combination of geopolitical risks, rising production costs, underinvestment, and slow development of new mines creates a supply-constrained environment. As demand continues to outpace supply, the stage is set for silver prices to reach unprecedented levels, making the $3,000 prediction a tangible possibility.
Ounces of gold. So a lot of free cash flow Newmont's throwing off. And if you look at their chart, it's pathetic. I mean, it's trading at $41. They were trading at, they've traded as high as 80 since 2020, and 60 is like kind of that's where they need to get to just to get back. So we're kind of in a retrace. But if you look at their volume on Friday, so all last week, gold prices were strong. But nobody on Wall Street was buying Newmont. I mean, the only way Newmont's going to have high volume if Wall Street is buying it. And the volume was pathetic on Friday. It was like, so that just shows you that the sentiment in the miners is still weak. And the reason why it's weak is because we're still in this risk-on trade. Like if you work on Wall Street right now and you go in your boss's office and go, man, we should be buying Newmont, you probably get fired. It's like, go look at NVIDIA, kid. Get out of my office. It's nobody's looking at the miners except for it's basically a small group of people. It's the outliers that are actually looking at the miners, and they're keeping their voices quiet. They're just looking at them, waiting. It's like, how long can we wait before we buy these things? I mean, people are getting excited. I mean, NVIDIA's at $1,000, and people are super excited about owning that stock. And they have like 3, 4, 5, 6% of their portfolio in NVIDIA, which is probably, over the next 2 years, if we do go into recession, I mean, maybe you might make, if you're lucky, you might break even, you might lose money, you might make 10%. Whereas in Newmont, over the next 2 years, if gold goes to 3,000, which I think it will, it's going to go up 200%, not 10%. It's going to go up 200%. So it's currently at 40, and it's going to go to 120. I mean, and nobody's looking at it. It's like we're kind of in crazy land. And the reason why is because Wall Street controls the narrative, and Wall Street is just talking about their book. They just point at the positive numbers. They look at GDP. So GDP is positive. Unemployment is under 4%. Earnings are, right around 8, 9%. So they're growing. The stock market is all-time highs. And the other data they look at, they basically say the next move for rate cuts is down. They're going to cut rates. So they just focus on those 4 things. That's it. And then they ignore everything else. They might mention it once in a while, but it's on the periphery. It's on the margin. It's not a significant data point. They just bring it up just to kind of not look like idiots, if you will. But they're totally underplaying the risk in this economy, which is super, super high in my opinion. And so that's the reason why this risk-on trade is in place, and that's the reason why the miners are being ignored. And at a certain point, we're going to have a pivot, and the pivot is going to be to risk off. And once we go to risk off, that's when that Newmont doubles quickly from 40 to 80, and then from 80 to 120. And then we'll see where it goes from there. If we go all the way to 3,500, then I think Newmont gets to 160 or higher. So
to fully understand silver's potential to reach $3,000 per ounce, it's essential to compare it with gold, its closest counterpart. Although both are precious metals with safe haven appeal, there are crucial differences in their market dynamics that highlight silver's unique potential for significant price appreciation. Historically, silver and gold prices have moved in tandem, influenced by similar factors such as economic uncertainty, inflation, and investor sentiment. However, silver has consistently shown higher volatility compared to gold. This greater price volatility means that while silver can experience sharper declines, it also has the potential for more dramatic gains. One key metric in comparing the two metals is the gold-to-silver ratio, which indicates how many ounces of silver are needed to buy 1 ounce of gold. Historically, this ratio has averaged around 15-to-1, reflecting the natural occurrence of silver relative to gold in the Earth's crust. However, in recent years, the ratio has often exceeded 70-to-1, and even spiked to over 125-to-1 during the COVID-19 pandemic. This indicates that silver is significantly undervalued relative to gold. If the gold-to-silver ratio were to return to its historical average, given the current price of gold, silver prices would need to increase substantially. For example, with gold trading around $2,000 per ounce, a ratio of 15-to-1 would imply a silver price of approximately $133 per ounce. Even at a more conservative ratio of 30-to-1, silver would be priced at around $66 per ounce. These potential price points underscore how undervalued silver is and the room it has for growth. Silver also differs from gold in its industrial applications. While gold is primarily a monetary metal used for investment in jewelry, silver has extensive industrial uses. This industrial demand makes silver's price more sensitive to economic cycles and technological advancements. As discussed earlier, silver is crucial in electronics, solar energy, and electric vehicles. The growing demand in these sectors supports a bullish outlook for silver, independent of its role as a safe haven asset. Additionally, central banks around the world hold significant gold reserves as part of their foreign exchange reserves. This institutional demand provides a stable floor for gold prices. In contrast, silver is not held in large quantities by central banks, making its market more susceptible to shifts in industrial demand and investor sentiment. This lack of institutional support can contribute to silver's volatility, but also its potential for rapid price increases when market conditions are favorable. The smaller market size of silver compared to gold also contributes to its price dynamics. The silver market is much less liquid than the gold market, meaning that smaller changes in demand or supply can have a more pronounced effect on prices. This liquidity difference makes silver more responsive to market disruptions and investor behavior. Investment vehicles for silver, such as exchange-traded funds, ETFs, have grown in popularity, providing more accessible ways for investors to gain exposure to silver. These financial products increase demand for the metal and can contribute to price movements. The ease of investing in silver through ETFs and other instruments has broadened its appeal, attracting both retail and institutional investors. Moreover, sentiment among investors and analysts about silver's future is increasingly optimistic. Experts like Don Durrett highlight the metal's undervaluation and its potential for substantial gains. This growing bullish sentiment can drive more investment into silver, further supporting higher prices. In conclusion, while gold and silver share some market influences, silver's unique characteristics and its relationship with gold highlight its potential for significant price appreciation. The historical gold-to-silver ratio, silver's industrial demand, market liquidity, and investor sentiment all point towards the possibility of silver prices reaching unprecedented levels. As these factors align, the prospect of silver hitting $3,000 per ounce becomes more plausible, supported by a compelling mix of historical trends and current market dynamics.
Dollar basically collapses. It's called The Mandibles. It's a beautiful read. I don't read fiction, but somebody told me, you got to read this book, and I really enjoyed it. And basically what she says is that the U.S. dollar gets replaced by something called the Bancor. And the Bancor is basically the Libra coin. It's basically a stable currency that's a combination of other currencies. They basically take it's not backed by gold. It's basically just a combination of other currencies. It's basically the same type of idea as the Libra coin. And that's what she said. That's what destroys the dollar. So what happens in that book? I'm going to ruin it for you, but what the heck? In that book, the fear that what destroys the U.S. dollar is our bonds. So our bonds, we keep inflating, and we're paying people back with deflating dollars. She wrote this book in like 2016. So we're paying them back in deflating dollars, and the world basically gangs up us and says, we don't want any more of your dollars. We want they created the Bancor, and they said, you got to pay us in Bancors. So you owe us $2 trillion and your bonds are, you owe us $2 trillion in US dollars. You have to pay us in Bancors. So you can't pay us in deflating currency. I mean, it's a brilliant idea. I mean, that's exactly what's going to happen, by the way, is either the world is going to basically say, you either pay us back, we don't want your stinking dollars anymore. We're holding your bonds. You pay us back in gold, or you pay us back in, something else. We don't want any more of your dollars. Forget about paying us a principal back in dollars or paying interest in dollars. We don't want them. We want real money, because you're basically just printing those. You're printing and you're deflating us, and we're getting back pennies on our dollars. And that, interesting, it's really good that we talked about this because it really brings us back to gold. That is the reason why gold's going up right now. Luke Gromen makes this really good point that if you buy oil with dollars, you don't get as much oil as you get if you buy oil with gold. So the rest of the world is basically going, we're just not getting any bang for a buck for these dollars. So we buy these dollars, we hold them, they go down in value. We buy them in gold, gold goes up in value. We're getting much more bang for the buck in gold than we are in dollars. And so these countries, they're buying commodities in dollars because most international trades in dollars, and they're getting the short end of the stick. And that's one of the reasons gold's going up here. Gold's going up here because more people are going, I want gold so I can buy commodities. So there's more demand for gold. So there's demand for gold from the central banks because they know that there's this change coming. And if there's this change coming, then I have all these reserves in dollars, and those dollars are going to be worth nothing. I better get some gold. So you got that going on. And then you have countries that say, okay, I need to buy commodities. Well, my dollars aren't going as far as they need to go, and they're getting cheaper and cheaper and cheaper. I mean, they say that inflation is like 2.5%, 3%. Well, if you go back and you look at how they used to monitor inflation, it's higher, right? They've changed the way that they do this. And so inflation is much, much higher than they tell us, if you will.
One of the most exciting dynamics in the potential surge of silver prices is the role of retail investors. These individual investors, often coordinating through online platforms and communities, have the power to significantly impact the market, especially for commodities like silver with smaller market caps compared to other assets. The phenomenon of retail investors banding together was prominently seen during the GameStop and AMC stock surges, where communities on platforms like Reddit's Wall Street Bets drove massive price increases. A similar trend is emerging in the silver market, where retail investors are increasingly buying silver, driven by its perceived undervaluation and potential for significant returns. Several factors contribute to the rising interest among retail investors in silver. Firstly, there is the allure of silver's historical price spikes and its potential for dramatic gains. Many retail investors view silver as a relatively affordable entry point compared to gold, which makes it an attractive option for diversifying their investment portfolios. The notion that silver could follow gold's upward trajectory, especially if the gold-to-silver ratio normalizes, fuels this interest. Social media and online investment communities play a crucial role in amplifying retail investor sentiment. Influential figures and analysts, like Don Durrett, who predict substantial increases in silver prices, help shape the narrative. Their insights and bullish forecasts are widely shared, creating a buzz that attracts more investors to the silver market. Videos, articles, and discussions about silver's potential for a price surge to $3,000 are circulating, galvanizing the retail investor community. The impact of this coordinated buying effort is already visible in the market. Retail investors have been purchasing physical silver in the form of coins and bars, as well as investing in silver ETFs and mining stocks. This surge in demand has led to significant movements in silver prices, and in some cases has even caused shortages of physical silver products. Dealers have reported increased sales, and premiums on physical silver have risen due to the heightened demand. Another significant aspect is the role of retail investors in exacerbating supply constraints. As more individuals buy physical silver, the available inventory decreases, tightening the supply further. This reduction in supply, combined with the rising demand, creates a perfect storm that can drive prices up. The concept of silver squeeze, where collective buying efforts aim to push silver prices higher, is becoming a reality. Moreover, retail investors are increasingly aware of the industrial demand for silver and its critical role in technologies like solar panels and electric vehicles. This awareness adds another layer of rationale for their investments, as they see silver not just as a safe haven asset, but also as a crucial component of future technological advancements. This dual demand, both industrial and investment, strengthens the case for a sustained increase in silver prices. The accessibility of silver through various investment vehicles also supports retail participation. Silver ETFs, for example, provide an easy and cost-effective way for investors to gain exposure to silver without dealing with the logistics of physical storage. These financial products have seen increased inflows, reflecting growing interest from retail investors. The collective power of retail investors should not be underestimated. Their coordinated actions can create significant market movements, especially in assets with smaller market caps like silver. As more retail investors enter the market, driven by the potential for substantial gains and the influence of social media narratives, the upward pressure on silver prices is likely to intensify. In conclusion, retail investors are a critical force in the silver market, capable of driving significant price increases through coordinated buying efforts and heightened demand. Their impact, combined with existing supply constraints and industrial demand, sets the stage for a potential surge in silver prices. The enthusiastic participation of retail investors, inspired by bullish forecasts and historical price patterns, makes the scenario of silver reaching $3,000 increasingly plausible. This dynamic underscores the importance of retail sentiment and collective action in shaping the future of silver prices.
It wasn't a majority rule. It was 100% across the board. So India basically vetoed any discussion. If you remember, they barely talked about it. Do you remember? They barely talked about the BRICS currency. And why? Because it wasn't a majority rule. It was a majority rule. They're like, yeah, we're talking about it. We don't care what you have to say. But the BRICS originally were countries, 5 equal countries. It was never a democracy. It was always equal partner, and each partner has to agree kind of thing. So now they're trying to expand this thing to like 25 countries. And I think it's going to go to 50 plus. So at a certain point, it's probably going to be a majority rule kind of thing. But when it's 5 countries, India had a veto. Now, does India still have their veto? We're going to find out in October. If they still have their veto, then they won't even talk very much about it, the BRICS currency. But if India is basically backed into a corner where they have to take it, then they'll talk about it. So it's going to be really interesting. Now, the one thing we haven't discussed is how does that impact gold? If they create a BRICS currency, I guarantee you it benefits gold because gold is going to be part of that currency. Absolutely. Because gold is something that China and Russia have been accumulating, and they want that currency to be backed by gold. They want to be backed by gold for several reasons. But the number one reason is stability of the currency. They saw what happened to the U.S. dollar. The U.S. dollar got deflated into the ground. They don't want this BRICS currency to get deflated into the ground either. So they want gold to basically be the substantial holding. I wouldn't be surprised if gold is at least 25% of it, maybe even 50. The 25 to 50 is my expectation, and the rest is either going to be currencies or currencies and commodities. I think it's just going to be gold and currencies. That would make sense. The one thing that I'm shocked that they're not doing, because, and I think people are going to find this fascinating, what I'm about to say, is if you go back and you look at what Facebook was trying to accomplish with their cryptocurrency, now I can't think of the name. Maybe I'll remember it when I'm thinking through this. So Zuckerberg, he basically said, I'm going to create my own cryptocurrency, and it's going to be based on all of the currencies around the world. So they balance each other out. So basically, it becomes the value of all the currencies around the world. It was Libra. It was called Libra. And so the Libra coin is absolutely a brilliant idea, because what you can do with the Libra, let's say you use 25 currencies, right? And then you rebalance those currencies on a daily basis, the ones that go up and the ones that go down. So it's basically a stable coin backed by currencies. So it's not backed by gold, but it's backed by currency.
All the factors we discussed culminate in a scenario where silver prices could skyrocket to $3,000 per ounce. This apex ties together the economic, geopolitical, and market dynamics that support this bold prediction by Don Durrett. Let's start by revisiting the fundamental drivers, the current market overview, economic data, and monetary policy. Silver has been trading around $30.80 per ounce, driven by a mix of robust U.S. economic data and geopolitical tensions. The Federal Reserve's hawkish stance has kept interest rates high, bolstering the dollar and limiting silver's gains. However, any shift in monetary policy towards rate cuts could weaken the dollar and boost silver's appeal as a hedge against inflation. Historical context provides a backdrop for silver's potential to experience dramatic price increases. Past moonshots during periods of economic and political turmoil highlight silver's capacity for rapid gains. The silver-to-gold ratio, currently skewed far above historical norms, suggests silver is significantly undervalued. A return to historical ratios would imply substantial price increases. Industrial demand for silver, driven by its critical role in technology and renewable energy, adds another layer of pressure on supply. As the world transitions to green energy and advanced electronics, silver's importance only grows. This increasing demand is set against a backdrop of declining mining production and depleting stockpiles, creating a supply crunch. Geopolitical tensions further amplify silver's safe haven appeal. Conflicts and uncertainties push investors towards assets like silver, driving up demand. Current events in the Middle East and other global hotspots create a risk-off sentiment that favors precious metals. Investor sentiment is crucial. The influence of market analysts like Don Durrett and the enthusiasm of retail investors amplify demand. Retail investors, inspired by social media and online communities, are increasingly buying silver, both physically and through ETFs. This collective action can significantly impact prices, especially in a market with limited supply. The silver mining industry is struggling with rising production costs, geopolitical risks, and underinvestment. These challenges limit the industry's ability to ramp up production in response to rising demand, further tightening the supply. Finally, retail investors play a pivotal role. Their growing interest, driven by the potential for significant returns and the influence of online narratives, creates a surge in demand that exacerbates supply constraints. The concept of a silver squeeze becomes more plausible as these investors collectively push prices higher. In conclusion, the combination of robust industrial demand, geopolitical tensions, limited mining supply, and enthusiastic retail investment creates a perfect storm for silver prices. Each of these factors independently supports higher silver prices, but together they create a powerful synergy that could propel silver to unprecedented heights. Don Durrett's prediction of silver reaching $3,000 per ounce is grounded in a comprehensive analysis of these interconnected dynamics. As we navigate this complex landscape, the potential for silver to achieve such dramatic price increases becomes not just a speculative fantasy, but a tangible possibility. The market conditions are aligned in a way that supports this bold forecast, making now an opportune moment for investors to consider silver as a crucial part of their portfolios. Remember, while the prospects are exciting, it's essential to approach any investment with caution and due diligence. This is not financial or investment advice, but a compelling analysis of why silver's future could be incredibly bright. Subscribe to our channel for more insights and stay tuned as we continue to explore the fascinating world of precious metals and market dynamics.
But it becomes basically the best currency in the world. Now, why wouldn't they use that idea? And then, they don't have to worry about gold. They don't have to worry, commodities. They don't have to worry about gold going up, going down. Currencies are based on GDP. So global GDP is basically your baseline. And some countries are going to do better than others, and so they get a better weighting. But I just thought that Libra is a brilliant idea. Well, the banks and the U.S. government, they basically, as soon as they heard about what he wanted to do, they basically said, no, you're not. You do that, we'll find the hell out of you. You're not doing that. Just take that idea and table it. They kiboshed it. They said, no, you're not. And they could do that because Facebook's a company and the U.S. government has regulatory power over them. Well, guess what? A government, if they wanted to create a Libra coin, nobody can stop them. Any government can do this. I've been waiting for a government. We just had Zimbabwe create the ZIG, the Zimbabwe gold certificate. So that's kind of a first shot under the bow kind of thing. I'm waiting for a country to create the Libra coin, because the Libra coin is absolutely a beautiful idea that will work, and you tokenize it. So you're basically creating a stable coin that's backed 100% by global currencies. It's the thing of beauty. Why isn't somebody doing this? And so, the BRICS are so caught up in gold, using gold to back their currency. They ain't even thinking about this. This isn't even on the table. They just keep talking about gold, gold, gold. So I think the BRICS will be backed by gold, but I do think that some country is going to create a Libra coin. They're going to basically have one of the best currencies in the world. So they basically, Argentina would be an ideal place, right? The Argentina peso is a piece of junk. They didn't want to go to dollar. They talked about it, but they're not. They're staying with the peso. Why don't they ditch the peso and create a Libra coin? The other win-win is the Libra coin's digital. So it basically becomes a CBDC where they can track transactions, which they want a CBDC. Well, if you create a CBDC that's basically, what I've just explained is basically perfect currency, then people accept it, and voila, you basically have a way to monitor transactions. So I expect I don't know why anybody hasn't been talking about this Libra coin. Like I said, I think Zuckerberg's idea was brilliant. I don't particularly like Zuckerberg. I don't like Facebook. I think on the whole, it's been a net negative to society, but we'll leave that at it. We'll leave 100% chance that they're going to do it. But the problem with the BRICS currency is that it doesn't help all of them. It actually penalizes the importers. It's like switching from the dollar, which penalizes importers with that bad currencies, to now this currency is going to basically replace the dollar. And I'll give you a perfect example is that India currently doesn't export a lot. And so they import. So what are they going to have to do? They're going to have to sell the rupee to buy this BRICS currency. So whenever they do that, the BRICS currency, they're selling it. So it's going to come under pressure. It's going to lose value. And if the BRICS currency, and I think it'll actually be a fairly strong currency. So if the BRICS currency is a fairly strong currency, India is screwed because the rupee it has to compete against that, just like it has to compete against the dollar. So they're like, they don't want any part of this thing. That's why I only put it at 70, 80%, because India, they might have kind of veto power, and they might be able to convince some of these other BRICS countries that, look, you're getting screwed, we're getting screwed, you're getting screwed too. What India wants to do, they want to trade in rupees, right? They're like, okay, we're going to buy your Russian oil in rupees. That's what they want to do. But, is it that conceivable? Now, China and Russia are net exporters. They don't have to buy any of these BRICS currencies. They're going to get paid in them. So it's beautiful for them, right? I mean, it's like a win-win for China and Russia. So if you're an exporter, you absolutely love it. It's like you're an exporter and you have this strong currency. It's like, wow, that's great, right? So it's problematic on implementation. It sounds good in theory, but in practice, it's not so simple because your country is giving up its sovereignty in many respects. You better export something. Now, South Africa, they don't export, they import. So that they might be negative too. They might be kind of in India's camp. Brazil exports a lot. They export food, they export oil. So Brazil's like, yeah, we're good. So Brazil, Russia, and China are like, yeah, what do we sign? We're up. I'm good. But India and South Africa, not so much. Nigeria is now, they're involved. They're exporters. So they get some of these oil exporters involved, Saudi Arabia, the Middle East, Iran. The exporters are like, sure, let's do it. So if this is a majority type of a situation where the majority gets to decide, then I think it goes through. But if you remember, when they were in discussions in South Africa last year,